if you own a home, if you invest in property, or you're just desperately trying to get on that housing ladder, there's a quiet shift happening right now in the UK housing market. On the surface, prices look pretty flat or are even gently rising. But what's important is beneath the surface, beneath the headlines, the data is starting to crack. This is the best graph I can find that visually demonstrates the mortgage interest rate ticking time bomb we have right now. That green line on the graph shows the outstanding fixed mortgages average rate. So if you averaged all of our current fixed mortgages, what is the average rate we are all paying at that time? And you can see as more of us have been renewing our mortgages onto higher rates, that green line, the average, is increasing and increasing as more and more of us go onto higher rates. The white line shows the new fixed rate mortgages available at any given time. So you can see pre-2022, before the Bank of England interest rates skyrocketed, the average fixed rate mortgage available always ran below the average outstanding fixed mortgages we all had, that we were all paying at the time. So in reality, in that green area of the graph before 2022, most people on average, when it came to renewing their mortgage, were renewing onto lower rates. So the positive side effect of that is as you lived in your home for longer and longer, the mortgage got easier and easier on average, especially as you would have been paying it down over that time. But just take a look at that red zone now. As interest rates have been skyrocketing from 2022, the average fixed rate mortgage has fallen behind the current rates available to remortgage onto. So until that red zone disappears, there are essentially more and more households still on their path to renewing onto far higher mortgage rates. So I've added a forecast to this graph of what will likely happen. That red area will keep getting smaller as more and more households renew onto higher rate mortgages. And hopefully the fixed rate mortgages available slowly start to drop as interest rates drop. Over this red zone though, we will keep seeing more and more forced sales as a portion of us just won't be able to afford our mortgage renewals. And so it should be no surprise to you that house prices adjusted for inflation have dropped 17% since interest rates skyrocketed in 2022. This is the graph that matters. Average house prices adjusted for inflation. This is nominal average house prices. So notice how it's been slowly increasing, but what has been hiding from this is inflation. This is the reality. Real house prices adjusted for inflation. In 2008, house prices adjusted for inflation dropped to 20%. We're at 17% now. Through this year and next year, this will get worse. And that 17% drop will surpass the 20% drop we saw over the 07-08 financial crisis. I don't think by much, but it will get there. So friends, can you see how interest rates and house prices, those two graphs are connected? Average mortgage rates skyrocketing here, and at the exact same time, average house prices adjusted for inflation starting to drop. But the government hides behind the fact that nominal house prices have grown slightly. Hooray. We can get poorer one of two ways, remember. We have less money, or the value of our money goes down. But when do you think this situation will improve? Again, let's ignore the headlines and look at the data. As you can see here, with more and more people facing rising mortgage payments, as more and more of us are still coming off our lower fixed rate mortgages onto higher fixed rate mortgages, it is quite obvious the housing market will keep being squeezed over the next few years. And if you don't know me and my background, I'm William Gale, and since 2013 I've run two national property businesses, British Home Buyers, a UK-wide home buying company, and British Home Sellers, a nationwide estate agency. Together, me and my great team have been involved in over 14,000 property transactions worth over £5 billion. Most of the properties we deal with are properties that have failed to sell with other agents, and we step in to help get our customers the best prices in a timescale that suits them. And right now we're handling around 500 properties a month across the UK. And I've never seen the market move like this. It's this insight to the property market, dealing with so many properties spread all over the UK at any given time, that makes me upset about how it's being dealt with. In reality, not just over the last 10 years, but over the past 50 years by a whole string of different governments. Because the property market significantly impacts the economy, but also society, our culture, the homes we raise our children in, whether we even decide to have children. Let me quickly go through 2 further warning signs I'm seeing on the ground here. Warning sign number 1 is asking prices are falling again. So according to Rightmove's July house price index, asking prices just dropped about 0.2% this month. But more importantly, they fell in almost every single region. So if Rightmove's asking prices are slipping, what's really happening to actual house prices? To understand that, you need to know something that most people don't realise. Not all house price data is created equal. You've probably seen different numbers flying around. One headline says prices are rising, another says that they're falling. But who do you believe? Well, each major index measures something different. Rightmove and Zoopla's shows asking prices, what sellers want, not what buyers are actually paying. And as I keep saying on this channel, about 80% of homes sell below asking price. The Halifax and nationwide house price data are based on their own mortgage approvals, only from buyers borrowing from those 2 lenders. They completely miss out cash buyers entirely, who often negotiate harder and make up 1/3 of all the buyers on the market. And they don't include each other's data. The land registry shows the most accurate picture, but it lags by months since it only updates after completion of a sale, and usually 2 or 3 months after that. Also, it doesn't adjust house prices for inflation. Inflation is the thing that's killing us. So when headlines report prices rising, it often depends on which index they're using, what data they're looking at. And many of those stats are either out of date or incomplete. That is why so many people out there are confused. But when you look across all the data, the real trends become clear, and that's the whole point of this channel. The next warning sign, the second warning sign, is buyer demand is flatlining. So according to Propertymark, agents are now holding 41 homes per branch on average, the number of properties they've got on the market, but only agreeing 9 sales per month on average. So they've got 41 properties, they're averaging 9 a month. That's a growing gap, and it points to oversupply. There are more properties on the market now than there have been for over a decade. But do you think there are more buyers out there buying? You tell me. I don't think so. So what is government's game plan here? I may be wrong, but I don't think the government is trying to crash the housing market as such. But what I do think they're trying to do is let inflation quietly deflate house prices over time. It's a managed correction. Let prices fall gently in real terms without triggering panic. If they wanted a housing boom, they could just put forward another stamp duty holiday and get a housing boom. But here's the problem. Mortgage costs are still high. We all know that. And real wages haven't kept pace. And affordability is more stretched than ever. That elastic band between house prices and income is getting tighter and tighter, and it can't stretch forever before breaking. I also think the tools they're using are too blunt. Why not have dynamic stamp duty rates that are different area by area? Struggling areas reduce stamp duty a little. Booming areas increase stamp duty a little. So what should you do? If you're a buyer, it's a buyer's market. So don't rush, but also don't assume a crash is coming. If you're a seller, be realistic. Pricing to yesterday's market is a fast way to get stuck. And my final thoughts on this are, look, I'm sorry again if this video seems a bit negative. I honestly follow where the data goes and aim to show you guys an untarnished display of the information so that you can see what the problems are and then debate in the comments what you think the solutions are. Every week, more and more of us are waking up to the reality that house prices might rise on paper, but real wealth is what matters, and that's being eroded away. So if you want to navigate this new world with your eyes open, with access to the data, subscribe to this channel, share it with your friends if you've enjoyed this. I've pinned some other relevant photos in the comments below, in the top of the comments, or I'll see you in the next video up here.